All right, so again, we kind of hit this a couple times in the show. We've seen a change in momentum, a lot of anxiety about what Jay Powell is going to say coming up on Friday and how dovish or hawkish he may be. What are your expectations? Do you think that he's going to signal a 25-point rate cut? Will he leave the door open for a 50-point rate cut that it seems the market really wants?
I doubt that he'll leave the door open for a 50 basis rate point cut. It doesn't make sense given the basic underlying economy. The equity market looks good. We've seen some weakness in the labor market, but that's debatable. And very importantly, some of the inflation readings have come in a little hotter than perhaps they'd like. So I don't think 50 is on the table at all. He might leave the door open for, I would describe it as sort of a moderate adjustment of one and done, 25. But that's, I think, about as far as he's going to be able to go.
All right, so what do you think Jay Powell's agenda is in this situation? We had CPI and PPI. In my opinion, CPI was kind of mixed because headline was better than expected, but core was a little bit hotter. And then PPI certainly was hotter than expected. How does he just kind of digest all that, especially when we know some people on the FOMC, they believe tariffs are only a temporary price bump? Well, that might just be the temporary price bump.
Look, I think he's going to have to acknowledge the data coming in. I think he's going to acknowledge, as you suggested, some of it was perhaps good news, but not all of it was good news. I think he's going to reinforce, sort of uncertainty and the risk kind of discussion that he had the last time. What he really wants out of all of this is as much optionality as possible. He doesn't want the market to get very fixated, let's say, on 50 basis points. He also knows that there are a range of views on the committee based on, incoming speeches. So Bostic has been, I think, a little cautious on this notion of a rate cut. Mary Daly out in San Francisco, perhaps leaning in a bit more with Waller and Bowman. So I think he's got a committee that has not yet coalesced. So I think his agenda here is state the facts, remind people of the dual mandate, risk to both sides, and try to avoid having too much built into the market to create as much optionality. I think he's also going to remind people, finally, Frank, that there is still data to come. And this is a data-dependent Fed, so we will have another round of inflation reports, another round of unemployment reports. I think he's going to remind people of that as well.
All right. Obviously, the Fed has a dual mandate. One is price stability. The other is the job market. What are you expecting from these upcoming job markets, and how does this Fed, and particularly Jay Powell, view it? We've seen some kind of shifts in the job market and also some downward revisions that, again, led to a controversial firing. But how does Jay Powell view especially those revisions when we're talking about the job market?
I think he takes them cautiously in the following sense. Some of those revisions, a pretty large percentage of them, had to do with government employment. What people don't realize is that the government tends to report its own employment numbers a little later than some other sectors. And when you get the dramatic moves that we've had in government employment, that leads to some of the kinds of surprising revisions that we've had. Second question on people's minds is, well, what's the best way to measure the health of the labor market? And a number of people are saying, look, the chief measure of the health of the labor market is the unemployment rate. That shows the balance of supply and demand. And right now, at roughly 4.2%, that's definitely in the range of full employment. And the argument is, well, the Trump policies have reduced supply and businesses are consequently reducing demand, but it doesn't mean that the market is out of whack. It means that it's a slower growing market because of policy issues. And there's not much that a much lower interest rate can do to offset that. And so I think around the labor market, there is a lot of debate, and that has not yet been resolved and unlikely to be resolved in the near term.
You know, Roger, we often lean on you just for your experience as the former Fed vice chair, but I want to go back to your former role as the CEO of TIAA. As someone who was a market participant, kind of go back to the days when you were actively involved in the markets, how would you view this inflection point when it comes to not only the equity markets, but also the bond market when we're talking about Jay Powell's speech on Friday?
Look, I think if one is really doing investing, you have to be more of a long-term investor and recognize that whatever he said, they're really trying to avoid upsetting an economy that looks like it's doing well. The clip that you played suggests very much that they think this is a pretty healthy economy, and I think that's probably a good signal for long-term investors. Whether they move 25 basis points or not during the course of this year, I think doesn't change the fundamental story of a pretty healthy underlying economy, and you see that in some of the equity prices not just here, but globally. And so I think this is a time where the fundamentals look pretty good, and monetary policy's job, I think, is to make modest adjustments at most so as not to upset the apple cart.